Hello, my name is Jerry McMillan, and I'm here to talk to you today about a topic that's near and dear to most of our hearts, and that is higher returns, and more importantly, safety while we're pursuing those higher returns. And I'd much prefer to be with you in person. Not always possible, but fortunately, we've got technology that allows us to keep moving forward when we can't be together and take advantage of the opportunities when we can. So, when we talk about higher returns, the first question is higher than what? It's a relative term. So let's take a look at what the historical returns have been by class of investment. And you can see two charts here, one by Wall Street Journal, other by Morningstar, comparing longitudinal views of returns from the mid-20s to the mid-90s in one case, and from the mid-20s to the mid-2000 decade in the other. And you can see similar returns by class, small stocks, large stocks, or Dow Jones Industrial, and you can see the real estate by comparison and bonds. You see the risk line because theoretically above that line is more risk, and it is in reality more risk than below the line. And then the so-called risk-free rate, which is the government borrowing rate, you can see and how those compare to inflation. And then to get your real return, you subtract the inflation from your nominal returns, and you can see what returns have looked like historically. So then when we say higher returns, we know higher than what. And then we look at more near term. Let's take a look at the U.S. stock market, the first line. You can see 1 month, which is very short. 1 year returns, but good. 5 year doesn't look quite as good. 10-year. So you can see some ebbs and flows built into those numbers. And so when you look at your returns, you got to look at it relative to a time horizon, because in any given time horizon, you could have a not so pretty picture. And depending on the timing of when you need to use the funds, you could be drawing down on funds that represent some opportunity costs. Okay, and then you can look at emerging markets, similar numbers, wider swings in some cases. Real estate investment trust index, you can see very short term doesn't look attractive. 1 year looks more attractive. 5 year unattractive. 10-year reasonable. The bond market, as you can see, has relatively lower numbers, as we saw in the prior chart. And the other thing that might surprise you is the amount of variation in your returns by period as you look at the government bond investment. Short-term bonds do better in the short term. Longer-term bonds do better in the longer term by design. And so you can see the relative recent returns. And the point here is the amount of volatility, which is the amount of unrest in our stomachs at night as we glance at our portfolios and take a look at the ebbs and flows and the ups and downs. So how do we get rid of some of that variation? How do we sleep better at night? How do we make sure we've got safe investments with solid returns? And that's the topic today. More on expected projected long-term returns from the 4 pillars of investment. You can see the real returns, which of course takes those nominal returns and subtract out inflation. Numbers similar to what we have seen in the past and project for those classes of investment long term. Now, again, the ebbs and flows, what it looks like from year to year, could be a little distressing, but in the long term, that's what you tend to look like. The issue is we tend to eat, live, and die in the short term. So let's take a look at what we can do to ease some of that anxiety. Clearly, we don't like excessive amount of risk. Charles Schwab Retirement Pulse Survey from May 2012, 35% of Americans consider protecting retirement assets more important than growing them. So we don't want to swing for the fences so much as what we want to do is make sure that they are safe and that they are growing at a reasonable rate. Only 8% consider growing assets more important than protecting them. Among the 49% of the respondents who say they were managing their portfolio risk with investments, about half of those are using cash. So 49%, about half of us are focused on managing risk, and about half of that in cash. So I would say probably about a quarter of our retirement money is in cash. The unfortunate part about that safety is you're losing to inflation. So how can we take care of our safety needs and not fall prey to inflation? Our value proposition is that very directly we'll pay you 10% return to invest in our development of quality homes for residential home buyers in America, and we'll pay 10% return by contract, no ebbs and flows, no fluctuations. It's an investment that you understand. Everyone understands housing. Everyone understands what housing being built looks like. And so you don't have the mystery of the stock market. You don't have the mystery of the derivatives. You don't have the impact of the masters of the universe. They're manipulating the equities markets and the derivatives and all of those esoteric things that we really don't understand, but our life savings are there. And so what we're talking about is taking some of that money from Wall Street to Main Street. That's how we get safety, is we take it from Wall Street to Main Street, so we can see it, we can touch it, we know where we understand it. That's how we get our safety, and that's how we know where our 10% comes from, because we really don't understand where those numbers come from Wall Street. In fact, the ratings agencies who get paid to understand and evaluate those numbers don't understand them, and that's why Standard & Poor's was duped by the derivatives developers in the mortgage debacle. So let's simplify. Go from the esoteric Wall Street to Main Street. 10%, you're investing in housing development, and you can touch it, see it, and know the value of it, and fully understand it. The same reason Warren Buffett invests in Dairy Queen and Coke. He understands burgers, ice cream, and sugar water. Now, your individual retirement arrangements are governed by Publication 590, IRS Publication 590, which is the guideline on eligible versus ineligible investments. So let's talk a little bit about how we can make this happen and move that money from Wall Street to Main Street and get ourselves some safety and solid returns. Common investments, believe it or not, single-family homes, multifamily homes, apartments, condominiums, commercial property, land foreclosures, eligible and common, as you'll see. Other possibilities, you can invest in LLC, corporations, partnerships, joint ventures, mortgages, loans, variety of investments that are eligible, although we were not led to believe that was so by the masters of the universe who want our money to go to Wall Street, but we're going to bring it back to Main Street. Now let's talk a little bit about what the publication says you cannot do. One big faux pas is self-dealing. You cannot do self-dealing. Self includes your spouse, includes your ancestors, your parents, your grandparents, your lineal descendants, your children, your grandchildren, spouses of your lineal descendants. Any fiduciary who has a responsibility to administer or give advice to your IRA cannot benefit from transactions. Persons providing services cannot benefit by your investment choices because it's not an arm's length situation. Corporations that you own more than 50% of, you cannot invest in. Now, those prohibited persons that we just talked about, transactions that we can't do, you can't sell, exchange, or lease stuff to them. You can't lend to them. You can't furnish goods or services to them for their benefit. You can't make an investment for the benefit of a disqualified person. For instance, you can't buy a beach home for an investment and have your daughter and son-in-law live in it. You can't, we talked about fiduciary responsibilities, and if it's questionable, it's probably disallowed. Two types of explicitly prohibited investments life insurance contracts. Now that's not to say you can't invest in an annuity or an equity investment provided by a life insurance company, but it cannot be a life insurance contract as the vehicle or instrument. Collectibles, what are collectibles? Works of art, ineligible. Rugs, antiques, metals, gems, stamps, cannot invest in them through your IRA. Sports memorabilia, Mickey Mantle rookie cards, Michael Jordan, whatever. No wine or scotch collections, no coins. You can invest in bullion, sell it on an exchange. So, how do you maximize your nest egg? By investing in our development of real estate. That's what we're here to talk to you about today. Development of homes, building of homes, and you get the benefit of investing on Main Street in something that you understand and can see and touch. And you get the benefit of stable returns without the ebbs and flows and heartaches of the masters of the universe playing with your money, and the community benefits as well. Winning team, we benefit, you benefit, the community benefits, and I'll give you an idea of the experience. These are pictures from actually our most recent development, from the foundation poured with the trusses laying out front to completed product, an example of what we produce. And I give you here some of my personal experience. I'm experienced in corporate project management, funding, residential lending for the past 15 years, process management, all about management. I've done over 100 housing projects between rehabs and new construction, 20 years of project management experience, educated and very, very much involved in this community of housing. So we ask you to invest in something you understand, and we have the depth of experience. Direct investment in real estate is not necessarily for everyone. And it's a lot of work, and there is expertise. And so indirect investment in these processes allow you to benefit without necessarily having to be knee-deep in managing the day-to-day processes and the day-to-day risks and performance. And you get your stable returns, and you get to see what you see right in front of you is development of value, creation of value that we can see and bring the money back to Main Street versus the esoteric machinations of Wall Street. Next steps, quite simple, straightforward. Initial transfer, you create a self-directed IRA account at one of the custodians, which I will show you a list of custodians shortly. You do the initial rollover, and then the next phase, we direct it to specific investment to us. Our processes, there's an initial direction of investment. That's a one-page form that directs the custodian to disperse the funds. The custodian manages making sure that all the appropriate documentation is provided. Then the investment returns are paid back into your IRA at the conclusion of the project. And then we go to an additional investment and repeat. Succeed, repeat, succeed, repeat, succeed. It's just that straightforward, just that easy. We've been doing it for a decade now with self-directed IRAs, and it's in and out and just that smooth. List of custodians. We've been doing business with some of them for quite some time. We don't have any arrangement to benefit by what custodian you use, but we do have experience with some. And once you choose a custodian, then we can get started, and you can actually, by this time next week, be fully engaged. That's the topic for today. Safe returns, stable returns, higher returns, taking your money from the esoteric machinations of Wall Street, taking it to Main Street so that we can build, we can provide value, we can provide safety, we can provide collateral, all the things that are missing from the esoteric investments in Wall Street. With that, we'll open it up for questions, and